Hey, welcome to part 4 of our discussion of money, banks, and monetary policy. So we're going to look a little closer at the idea of how do banks create money. Now, we know that the bills in the United States have to be created by the federal government, but banks actually have the power to create money. This is going to, we'll see, this poses some issues as that policymakers have to consider. So deposit creation is a term. It refers to the process which a fractional reserve banking system, which we learned in the last lecture, online lecture, a fractional reserve banking system turns $1 of bank reserves into several dollars of bank deposits. There is a government minimum, but without considering the minimum, what level of reserves would banks want to hold in general? Well, they want to hold as little as they can. Money that's held in the vaults can't earn interest income, whereas money that's lent out can. The interest income, I mean, if you think about mortgage rates, once again, maybe you can get 3, 4, 5, 6%, depending on exactly when. Different times, mortgage rates can fluctuate. But let's just say it's 5%. If a bank has $10 million in deposits, if they can earn 5% interest, that's $500,000 they can get in interest income if they lent out all of their money. Now, if they lent out half of their money, they can only make $250,000. That's a pretty huge difference. Now, the U.S., the number is 10%. Banks must keep 10% on reserves. Now, we define excess reserves as any reserves held in excess of the legal minimum. So this reserve ratio, which we say is 10%, it does play an important role in the amount of money in circulation. And we're going to look at an example, and we're going to say this is oversimplified because there's a couple factors we're not considering. But it'll still give us insight into how the system works. So let's consider an oversimplified example. Suppose that somebody digging in their backyard, and there's a bag with $100,000 in it. They are a happy camper. So, $100,000. They go to the bank. They deposit in the bank. Now, what would the bank do with a 10% reserve ratio? So they have to keep 10% on deposits in reserves. Well, they'd want to lend the other $90,000 out. And if they get 5% interest on that, they could make $4,500 in a year based on lending out $90,000. Well, what happens with the $90,000 then that's lent out? It's not like it stays in cash, right? The bank sets up a new checking account for somebody who wants a loan. So the bank sets up an account for $90,000 for somebody. Well, that's an additional deposit at the bank, right? You know, I mean, you could think of the process that maybe the bank hands the $90,000 in cash to somebody, and then the person then takes the $90,000 and hands it right back to the bank. Basically the same thing as the bank just creating a $90,000 checking account for the person. But let's go with the simpler way. Let's suppose the bank brings out $90,000 in cash, and the person says, actually, I'm going to open up a checking account here, please. Well, that means the bank gets another $90,000 deposit. They kept the $10,000 on reserves from the first deposit, lent out the $90,000, but then the $90,000 comes back to the bank. So the bank now has one person who has $100,000 in an account, and a second who has $90,000 in an account. What does the bank have to do? Well, they had to keep $10,000 in reserves from that $100,000 deposit, $9,000 in reserves from the $90,000 deposit. And the process is going to continue, and I'm actually going to open up Excel to help show what's going to happen here. So let's suppose that, let me make this a little bit bigger. So the initial deposit is $100,000. So I'll expand that. And that's the initial deposit. And then the amount that's kept in reserves, well, that equals 10% of this, right? So 100,000 times 0.1, $10,000. I don't think we need to. Well, if the bank then lends out that other 90,000, as we talked about, that would mean That deposit's 100,000 minus the reserves. The next amount that's put on reserves from the $90,000 is $9,000. So now our total amount in reserves, and I'm going to bring that all the way down here, total amount the bank has in reserves is $19,000. The total amount the bank has in deposits is $190,000. Right? Somebody found $100,000 and put it in the bank, but now the money supply has actually gone up by, it's now $190,000. It's gone up by $90,000, and that's just based on the first loan. We would expect this process to continue, right? The bank got a $90,000 deposit. It has to keep 9 of it. That means it has $81,000 to lend out to somebody. Well, they lend it out. They do need to keep $8,100 of it, 10% of that deposit in the bank. Now the money supply has gone up by $271,000. The reserves are $27,100. The next time they could lend out $72,900 because they kept $8,100 of the $81,000 on reserve. They lend it out, it comes back to the banks, and they have to lend out $72,990. Now, the question of it coming back to the banks, right? The people who get the loan get a checking account, then they buy things. But the people who they buy things from, they use banks as well, right? If you get a check from somebody, it could go into a bank account. The businesses that get loans, this goes into accounts. They buy things from other businesses. So the idea that it comes back to banks is not a far-fetched idea at all. We would expect this to happen for the most part. So $72,900 is the next amount that's deposited. They have to keep $72,990 in reserves. And the process just keeps on going. Right after they've made, this is first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, the 10th deposit, well, they can only lend out $38,000 now. But we're starting to get, we're already getting to the 10th deposit. Now, if we go through 12, we could see that 71,000 are in reserves, and our money supply has gone up by $717,570. That's from a single $100,000 discovery of money. It's a pretty enormous increase in the money supply based on that. Now, I'm even going to drag this down a little bit further just so we can start to see where this is going to converge to. So I'm going to take this, instead of A13, we'll say it's A23, and do the same. Now let's see what happens as we go here. Well, the amount that they deposit, it keeps decreasing, and we can see we're up to over $900,000 in the money supply and $90,000 in deposits. Now, it was an initial $100,000 deposit, so we know that this can't hit over, that amount can never get over $100,000. What we will see is with a reserve requirement of 10%, this is going to move to, it's going to converge to, the money supply is going to go up by 10 times the amount of the deposits. So after, 7 transactions, it was over $500,000, right? 2, 4, 6, 7. We went through 22 transactions, and we're over $900,000 in deposits. The term for this is it's called a money multiplier. If you have a deposit, the amount of the deposit is going to go up by more than, far more than the initial deposit. The amount of money in the money supply will be multiplied. And the formula for the money multiplier, it is 1 over 1 minus R, where R is the percentage of money that could be lent out. The formula that I think is a lot easier, so you see the Z point by it, is the money multiplier equals 1 divided by the reserve requirement. So if the reserve requirement is 0.1, the money multiplier is 10. If you have a reserve requirement of 0.2, the money multiplier is 5. Changing the reserve requirement a small amount could have a huge impact on the money supply due to the money multiplier. Now we said it was a little bit this oversimplified. Well, our oversimplified money multiplier formula, the change in the money supply, whatever that new deposit is, times 1 divided by the reserve requirement. Now this can work in reverse, whereas if you have a withdrawal, people take money out of the money supply, that could lead to a multiplied contraction. So the more money is kept in banks, the greater the increase in the money supply. The more that's kept out of banks, there's going to be a decrease in the money supply. It is oversimplified. A couple reasons. One, while we do expect most of the money to be kept in banks, if individuals do keep any of it in cash, the money, we're not going to see a multiplier that's quite the amount of our formula. It'll be a little bit lower. Second, the banks have to not hold reserves that are larger than the legal minimum. So it goes down to the required reserve ratio. If banks decide to hold a little bit more, the amount that the money supply would be multiplied by is a little bit less.